This is a really important point to stress. Cryptocurrency does nothing to address 99% of the problems with the banking industry, because those problems are patterns of human behavior, their incentives, their social structures, their modalities. The problem is what people are doing to others, not that the building they're doing it in has the word bank on the outside.
So this is another point that, if you accept the way that it's framed, sounds really good. But are the only problems with the banking industry's social structures and modalities 99% of them? And does rebuilding a financial system upon a different framework not provide an opportunity to adjust incentive structures and use different modalities? I can concede that Bitcoin and crypto aren't going to implicitly solve the problems with society at large, but I'm not sold on the idea that decentralized finance won't make a difference to 99% of banking's problems. Let's take an example that's explicitly stated as a goal of cryptocurrency: banking the unbanked. At the moment, about 6% of the United States is unbanked, and about 16% are classified as underbanked. Banks often require specific forms of identification and various other account requirements like minimum balances and monthly service fees for opening and maintaining accounts that contribute to the increased cost of being poor. Oftentimes it's minorities that are disproportionately affected by this cost. If you can't afford a bank account and thus can't get direct deposit, where do you cash your checks? Probably a place like Walmart that charges extra for that service. If you need to use credit for an emergency expense and can't get approved for a short-term personal loan or a decent credit card or line of credit from a bank because you don't have a credit card history, have a poor credit card history, or just don't have a bank, well, these are the types of people that end up having to use payday loans. That debt cycle is basically a micro-scale version of the IMF's debt trap. All it takes for a poor person to get stuck in that cycle is a single bad turn and a moment of desperation. They may even know that it's a bad idea, but need to resort to such things in order to make it to the next payday. Hence, payday loans. And these loans have ridiculous interest rates, which are normally limited, but payday loans get around this by calling them renewal fees instead of interest accrual. Wouldn't it be nice if we had a way around that? Peer-to-peer blockchain lending is a way around that. And crypto wallets, as Dan pointed out earlier in the video, are essentially a way around bank accounts, given the proper infrastructure. This is not nothing. With the proper infrastructure, they can also be a way around ATM fees. Now, to be clear, I qualified that with the proper infrastructure because that is currently not the case yet anywhere except El Salvador, where their Chivo wallet actually bypasses ATM fees and enables you to bypass the banking system while also having crypto ATMs if you want to use fiat. Otherwise, the money essentially has to go through banks anyway if you want to convert to fiat. This is not even to mention the informal tax on poverty in the form of overdraft fees, which don't exist in crypto. Remember that many banks deliberately reorder your transactions for a given day to maximize how much they get in overdraft fee. Also, it costs a shocking amount to have to pay your bills in money orders every month because you can't afford to keep a bank account open. With regard to Bitcoin and other crypto assets, with fixed monetary policies, the protection from inflation is also kind of a big deal, as the loss of purchasing power from inflation also tends to hit poor people, once again disproportionately minorities, harder than wealthier people because of the way inflation is typically distributed. Food, transportation, housing, and healthcare are often affected the most by inflation, something that's not well captured by a lot of traditional metrics. There's total market inflation as measured by things like CPI or core inflation, and then there's personal inflation rate, which is weighted by how much you actually use goods and services, which is much more relevant to you on a daily basis. As many are fond of saying, Bitcoin at its heart is not a get-rich-quick scheme. It's a don't-get-poor-slowly scheme. Protecting your purchasing power from inflation is kind of a big deal, and arguably one of the basic reasons that you need to invest in assets that appreciate in value over time, even if you have no interest in getting rich. This feature of Bitcoin and various other crypto assets is particularly important in less stable countries whose governments are actively debasing the currency in order to, fund debt, basically. This, as we'll cover a bit more later, is both the reason that the crypto narrative has moved away from medium of exchange And the reason it's gone more towards store of value, as deflation is good for saving and bad for economy scale currencies. And this is just the start. There's more reasons that crypto assets are useful in ways that the banking system isn't, as crypto Twitter is fond of reminding Peter Schiff basically every day. But, you might ask, what about the more complex financial instruments like collateralized debt obligations and mortgage-backed securities? Well, wouldn't you know it, those already exist in crypto. Now, one could argue that the transparent nature of blockchain-based financial applications could limit the downside of using these complex derivatives, that the risk profile of the average DeFi lending app is vastly different from that seen in the financial crisis, and that DeFi apps have little chance of actually becoming insolvent because of programmatic liquidation settings. But the fact remains that they are still there. These things still exist in crypto. Not only that, but get this. The company that reintroduced CDOs and credit default swaps into the world of crypto was unironically called Opium Finance and funded in a private sale, among other sources, by ex-Goldman Sachs executive Mike Novogratz, a concrete example of an old guard financier's influence being used to drag Web3 back into dark waters. Told you I wouldn't forget. In this case, by the way, Novogratz was actually a relatively early investor, getting in around 2013 when Bitcoin was around $100, during a period when he was ostensibly retired from finance and from working with Goldman Sachs, one of the banks behind the great financial crisis. But even he approached crypto in a purely speculative way, as recently as 2017, calling Bitcoin a bubble, being purely to enrich himself in his capacity as a smoke vendor before everything went crashing through the floor. He fits better into the folding ideas narrative than any example actually given in the original video. But 5 years after his bubble statements, time in the markets have done so far nothing but prove Novogratz wrong about his assessment of Bitcoin and made him a billionaire again. He may have gotten in thinking he could trade a massive amount of smoke, but he's accidentally stumbled onto the hardest asset he ever touched. He sings a very different tune now, citing the maturity of the ecosystem, although his support is something the crypto community only begrudgingly accepts. We are very aware of his past and connections, and the irony of his role in the ecosystem is not lost on us. The fact remains that Goldman only recognized Bitcoin and crypto as a legitimate investable asset class as recently as last year, 2021, after over a decade of dismissing and then deriding it to the media. Mike is an exception and by no means a smoking gun for bankers' early interest in the crypto market more broadly. Now, I will not sit here and tell you that blockchain has solved the problem of risky, complex financial instruments and their potential for being used to exploit the poor and minorities simply by existing. This claim is demonstrably false. I just demonstrated it. There is no conceivable mechanism to both benefit from the high level of adoption implied by the entry of big financial players into the market while simultaneously barring them from participating in, profiting from, and ultimately influencing the system for their own gain. At some point, they're going to get involved. What is a project to do then? Just close up shop and rug pull the whole ecosystem the moment that dirty VC money rears its ugly head to preserve ideological purity? Global adoption will result in the involvement of some unsavory players, just as a matter of course. Global means everyone. However, to say that 99% of banking's problems are not solved by cryptocurrency simply because 100% of those problems are not, seems like a bit of a stretch. And putting that responsibility on Bitcoin specifically makes no sense. We'll revisit these ideas when we talk about Ethereum.